Get into key financial formulas. Okay, so loan to value. Obviously loan to value is how much debt you have on a property. If you have a $100,000 property and you owe $60,000, that's 60% loan to value, right? So that's loan to value. All right, I'm not going to belabor that one. I'm not going to do that. Okay, now remember, this is probably the most important thing you're going to focus on, the NOI, the net operating income. Because again, any increase to that NOI is an exponential increase to the value, right? So it's the gross income from all sources, less operating expenses for the property, not debt. That equals the NOI, okay? Okay, now, this is a formula to determine the cap rate. Remember IRV, I-R-V, okay? So if you have any two of these things, the cap rate, the value or the purchase price, or the NOI, if you have any two of those three, you can figure out the third missing one. So, the net income is on the top, the cap rate is on the left, and then the value or sales price is on the right. And so if you need to determine the value, you divide the NOI by the cap rate, okay? That's how you determine the value. And remember, I gave you examples where we increased the NOI and I plugged in a cap rate to those examples that I showed you and massively increased the value by doing some of the things didn't even cost us anything. Now, if you know the NOI and the value or the sale price, you can determine the cap rate because you divide the NOI by the value, you get the cap rate. Now, if you need to figure out the NOI and you know the cap rate and the value, you multiply them together, you get the NOI. So there you go. So remember IRV, okay, guys? We're going to talk about cap rate a little bit more in a second here. Okay, right now. Okay, so the cap rate is the rate at which the NOI repays the purchase price on an annual basis, okay, on a cash basis. And the formula for calculating the cap rate can be expressed, basically, which is the cap rate equals the NOI divided by the current market value, like I just showed you, IRV. And again, if you've got any two variables, like I just showed you in the last slide, you can calculate for the third, okay? Now this is in your book, so I'm going a little faster than I probably need to, but you can go back to this if I'm going a little too fast. Now, what affects cap rates? I'm going to tell you the biggest thing is risk, okay? But other things, location is obviously very relevant. What asset class is it? What's the market conditions there in that area, and even in that submarket? The current supply and demand, which is huge right now, a big one. The property's ability to appreciate, how much property management is going to be required for that property, and what the tax benefits look like. So all of those things affect it, but the biggest thing is risk. Now, here's the thing. Class A and B properties have very low cap rates due to their stability. By the way, low cap rate, higher price. It's counterintuitive. High cap rate, lower price. So a low cap rate means a large investment for a small income stream, okay? And D properties have high cap rates because they're risky. Now, a large cap rate means a smaller investment for a larger income stream. But keep in mind, cap rates have nothing to do with the financing. It's based on cash, okay? And originally, cap rates were created for investors to compare different asset classes, believe it or not, different types of assets, not just multifamily. Okay, so here's some average cap rates. Although these numbers have gone up slightly, I should adjust these now. But Class A, typically I would say, 3 to 4 is probably still good. 3 to 4%, Class B, 3 to 5%, C, 4 to 6%, and Class D can be as much as 12%. But I like to see cap rates of 6% or better, okay? That's what I like to see, okay? And this isn't, by the way, that's not the only thing we look at when we're looking at a property. We look at lots of other things. I'm going to tell you about those in a second here, but cap rate's one of the factors. So we're going to take a quick break from this incredible episode for a word from our sponsor, my incredible freaking Warrior program. I've got this amazing mentorship program. My students are called my Warriors, and at last count, they own somewhere between 190 and 200,000 units that we know of. It's an extraordinary group of people that are just flat out crushing it in multifamily. If you'd like to apply to our amazing Warrior program, text the word CRUSH to 72345, and we'll set up a call. You can look us over, we'll look you over, and I can promise you, even if you don't join the program and it's not a fit, you're going to leave that call better than when you got on it. So again, text the word CRUSH to 72345, and you and I will speak soon. All right, let's get back to it. Okay, This is very interesting because this graph shows you what happened in the crash of 2008 and 9. So you can see how obviously prices massively dropped, which I believe is coming later this year or next year. I actually absolutely believe that's coming. That's why I think you're in the right place at the right time. I'm certain of it, actually. There's so many deals in trouble right now in our space. Now, I'm not talking about houses. I'm talking about multifamily. Okay. But you can also see what happened to the cap rate. See how the cap rates jumped? So they obviously go hand in hand. So the cap rates went up, values go down. That's how it works, okay? So that's what happens in a crash. And I believe it's coming. I really do. I think it's already upon us. It's just like I say, lenders are kicking the can down the curb right now, but it's going to come to a head. Has to. Okay, so this is an example of cap rates by class. So you can see Class A's down at the bottom, Class A preferred markets. Now, when you're dealing with conforming debt like Fannie Mae and Freddie Mac, they have preferred markets, big metropolitan service areas, MSAs, that they know have tons of employment. They've had great results in those MSAs. Those are preferred markets. You go into smaller or tertiary markets, you're not going to have that status, but you can get better loans when you're in a preferred market. So regular Class A is in the middle line there, and then Class B and C is at the top. And so you can see, that they trend together like that. And take me off for a minute just so they can see what happened further down. This slide's a little dated, but you see what happened there. Okay, you can put me back in. Okay, now how do you determine the cap rate for a property? You can obviously check and see what properties have sold for. If you can get the NOI information, you know what the sales price, you can figure it out. You can talk to other investors, property managers, lenders, brokers, appraisers, and all of them can help you determine cap rates in a particular market. Okay, the operating expense ratio. We've talked about this a few times. Remember, the average is 50%, okay? And you take, you take the operating expenses and you divide it by the income and you come up with the percentage. It's pretty straightforward, right? That's how you determine the operating expense ratio. If you got 100,000 in income, 50,000 in expenses is a 50% expense ratio. But if you don't have those exact numbers, you just divide the expenses by the income and you come up with the percentage, right? Okay. Now, this is another factor like cap rate that we look at when in fact, this is the one I like the most. This is the one I pay the most attention to personally, okay? This is the cash on cash return. And the cash on cash return is the amount of cash your equity makes on an annual basis. So if you're talking to investors and they put in 100 grand and you tell them you're going to get 10,000 a year return on your 100 grand, obviously that's a 10% cash on cash return, okay? And that return is calculated by taking the NOI. Now this actually does take the debt into account, okay? You subtract the NOI with the annual debt service and then divide those two things by the out-of-pocket expenses to come up with that cash on cash return. Okay, so remember that equity that you put in to buy the property, remember we call it equity, it's really the down payment, but it also includes closing costs, capital expenditures. Again, I want to put operating reserves on here as well on this slide, please. Okay, includes closing costs, capital expenditures, operating reserves, all of that, your down payment basically, and the money you're raising. And then however much money you anticipate making on an annual basis will determine, your cash on cash return based on how much money you have in there. Remember, if somebody invests 100 grand, they get 10,000, it's 10%. It's pretty straightforward, but it gives you a really accurate figure on your return, and it does include debt. I like to see 9 or 10% on cash return. Okay. So here's an example. Now this is kind of a bare bones basic example. Let's say you paid $1 million, you put 25% down, 250,000 down. You got a bank loan for 750,000. You're assuming no repairs. You're assuming no closing costs. This is really not a great. In fact, I want to redo this slide because it's just too basic. Okay, make a note to me to redo this slide. But it's simple for this purpose. So let's say you got $250,000 invested basically out of pocket. Let's just assume that includes closing costs, CapEx, operating reserves, everything. Total out of pocket's $250,000, and cash flow after debt the first year is $50,000. Well, that's a 20% cash on cash return, which is amazing. You don't see that, but it'd be great if you did. But so anyway, hopefully I didn't do that too fast and you guys got it. Okay, now So cash on cash is one metric that you tell your investors. And by the way, when I show you the sample deal package tomorrow, I'm going to go through it and show you how we present a deal and what we look for. It's really going to pull all this together for you. It's late in the day, but you're going to love it. You definitely want to be there for that. And we quote in the pro forma on this deal the cash on cash return, but also the internal rate of return. So what's the internal rate of return? It's basically includes all the different returns that you're going to get on a property. The appreciation. So, you determine what you're going to sell it for. You calculate in the appreciation. The cash flow for, typically it's a 5-year window that you're looking at. That's the most common. So someone will calculate what they think they'll sell for in 5 years, what the cash flow will be for those years, and how much principal reduction you have on the debt. And that's the internal rate of return, okay? That's the includes everything. And I like to be in the 17 to 20% range for that. Okay, we talked about the debt service coverage ratio. So again, in our world, they're not looking at your debt to income to buy a property. They're looking at the property's ability to service the debt, okay? Most lenders want to see a 1.25% debt service coverage ratio, okay? And so again, as an example, let's say your net income on a property is $125,000. Your debt for the year, and this is annual, okay? Your debt for the year is $100,000. Okay, $100,000 in debt, $125,000 in NOI. That's a 1.25% debt service coverage ratio. Now, if your net income is $85,000 and your debt is $100,000, that's a 0.85% debt service coverage ratio. It's not even covering the debt. That's a problem, right? Okay, so again, this is a very important calculation that lenders look at, okay? And this is becoming, a really big deal because the rates are so high. This is why people can't refinance right now. They can't meet their debt service coverage requirements, so they can't refinance. Sales are down 90%. This is why the proverbial, what's about to hit the fan, guys. It's coming, okay? You're in the right place at the right time. Okay. So there's the calculation to determine your DSCR. You just divide the income by the debt. It's very simple. Okay. So there's my minimums. Now debt service, I like to get to 1.6. I like to see a cap rate, in the ideally the 7% range. Cash on cash 8 to 10%. I think I said 9 to 10, but 8 to 10 is fine.